Thinking about buying a business or perhaps selling one that you've built from the ground up? Before you make one of the biggest financial decisions of your entire life, it is quintessential to understand the murky world of mergers and acquisitions, and I'm here today to walk you through it step by step. My name is Molly, founder of Greenwald Financial Group. As a CFO advisor and business strategist, I've been involved in a multitude of deals ranging from small strategic acquisitions to large multi-million-dollar exits. In this video, we're going to dive deep into the M&A process, what to know, how to prepare, and how to avoid costly mistakes. As an aside, I'm extremely passionate about mergers and acquisitions, and I think it's one of the best techniques to employ in scaling your business. In fact, the engagement in systematic, programmatic M&A is one of the best tools that you have in your business arsenal, but we'll save that for a later date. Today, we're just going to discuss the basics, mergers and acquisitions 101, just so we understand. With that being said, what is a merger? What is an acquisition? A merger is when two companies form together to form one entity. An acquisition is when one company buys another outright. So, why do people engage in these transactions? A little bit of a hint, I kind of gave it away earlier in this video, but the reasons being talent and technology acquisition, competitive advantage, exit strategy for business owners, and growth and market expansion. In mergers and acquisitions transactions, you're typically going to find three classes of buyers. Those classes include strategic buyers, which are other businesses, financial buyers, which are venture capitalists, private equity, or VC and PE firms, as well as investors. And then you'll have internal buyers, which are going to be employees or partners of the organization. So now let's break down the M&A process into 5 core phases. Number 1, preparation and strategy. Here, you need to ask yourself the goal. Why are you doing this? Why do you want to engage in M&A? Are you buying to grow? Selling to retire? Because this is going to shape the entirety of the plan. In this phase, you're also going to assemble your deal team, which is going to be comprised of an accountant, an attorney, an M&A advisor, or a CFO, just like us. Phase 2 is target identification for the buyer or teaser creation for the seller. So it depends on, if you're the buyer or the seller, what you're going to be doing in each of these key phases. For buyers, this is when you're going to identify target businesses that align with your strategy and that you would consider buying or purchasing. For sellers, this is when you create something called a confidential information memorandum, or SIM deck as we call it in the business. This SIM deck is something that contains key confidential information regarding the operations, logistics, and finances of your business. It's something that when a buyer is showing strong interest, or even when they've signed an LOI or letter of intent, that you would then present to them. Phase 3, which is arguably the most arduous, is called due diligence. Now, it is in this phase that the majority of deals fall apart, and we'll get to the reasons why. Due diligence is comprised of financial due diligence, including the review of quality of earnings, financial statements, cost of goods sold, revenue streams, really anything financial. Then there's operational due diligence, which is a review of human resources, systems, processes, protocols of the company. The third facet is legal due diligence, which includes entity structure, contracts, intellectual property, and any pending litigation. Now, as I said before, this is where most deals fall apart. And that's because any red flags by way of compliance or in your numbers or unclear ownership is enough to make a potential buyer drop the deal and walk away. Henceforth, the reason you need to have this planned and you need to be ahead of the game when it comes to M&A and due diligence in particular. Phase 4 is deal structuring and negotiation. Here is where you're going to identify and discuss between the two parties the terms of the deal. This means the price, the earnouts, the seller financing, any non-compete clauses. You're also going to discuss tax considerations on both sides, as well as whether it's going to be an asset versus a stock purchase. The fifth phase is called closing and post-merger integration. In this phase, you're going to discuss transition planning, operational alignment, and then retention of key staff and customers. In a later video, I'd like to actually do a whole segment on post-merger or post-acquisition integration, because that's a pain point that I personally have seen occur, that it's not so much the transaction itself, but it's the failure to execute and integrate the companies properly into the new wheelhouse in an efficient manner, which can be the downfall for some. But again, let's save that for a later time and keep moving on with our basics here. Now let's discuss business valuation, because this is pretty important. How is a business valued? Well, there are three common approaches, and the first is the market approach, which is comparable company sales. The second is the income approach, or the discounted cash flow. This is my personal favorite, as I believe it gives the best all-encompassing financial picture of an entity from past, present to future. But everyone will have their preference, I suppose. And the third is asset-based valuation, which is especially prevalent in asset-heavy businesses. In addition to the methodology, you also have to consider the multiples. Now, typical multiples vary by industry. For service businesses, this is going to be about 2 to 4 times the EBITDA, or earnings before interest, taxation, depreciation, and amortization. For tech or SaaS, aka software as service businesses, this is going to be 5 to 12 times the revenue. Now you understand why those businesses are doing so well, huh? And for Main Street businesses, it's approximately 1 to 3 times the seller discretionary earnings, or SDE. Other factors that affect the value are things that we've kind of discussed: clean and accurate financials, recurring revenue, diversified customer base, strong team, and systems that scale. Remember, anything that augments the value of the business and sets it apart from its competitors is going to affect business valuation. So yes, it's heavy on numbers, but there are other aspects as well. Something that I suggest that before you list your business for sale or before you consider buying a business is that you get a quality of earnings report, or a Q of E as we call it. This is really a financial deep dive that's going to validate all of the numbers that you've seen presented to you. In fact, even if you're not considering engaging in a mergers and acquisitions transaction, I highly recommend that CEOs request a Q of E report from their internal financial teams to give them this same insight, because really and truly it will help to augment their decision-making process. So now let's discuss, what do sellers need to do? If you're thinking of selling your business in 1 to 3 years, here's what you need to do right now. Yes, you heard me. If you're thinking of selling a business in 1 to 3 years, these are the things you need to do immediately, right at this moment. Number 1 is to clean up your financials. That means getting rid of any personal expenditures, ensuring that all of your categories and classifications are accurate, and that all your reconciliations are complete. Furthermore, you should also hire an external CPA firm to conduct reviewed financial statements. And essentially, a reviewed financial statement is just an audited financial statement that you're bringing on yourself. The reason for this is, one, that most private sales require 3 years of reviewed financial statements in order to consider buying a company, and they do that because having an independent auditor, an independent, unbiased opinion about the status of the financials is a way to reassure a potential buyer that the numbers are accurate and that the data they're looking at is sound. Number 2 is systematize your operations. This means that the business has to run without you, aka without you, the CEO. Number 3 is going to be the organization of key documents, including entity structure, tax returns, contracts, employee records, leases, and all of that stuff that's going to matter to a new owner. Number 4, since we talked about valuation, now is the time to boost your valuation drivers before you're even valued. This means locking in your contracts, diversifying revenue, reducing owner dependency, all of which will help to augment that. And number 5, and most important, get a financial partner on your side. An M&A advisor can position your business for maximum value. Here are some of the most common mistakes that I've seen in M&A. Waiting too long to prepare, overvaluing your business emotionally. This is something that's fairly common for CEOs who've built a company from the ground up because they hold it with an intrinsic value that doesn't necessarily stand on the open market. And a financial professional and all of this data can really help to have realistic expectations of the value of your entity. Another common mistake is not understanding the tax implications on either side. Also, failing to vet the buyer or vet the seller. Remember, due diligence stems beyond what takes place inside the company, but also stems to who owns the company and whether you want to be associated with that or whether they have the means for it and all of that. It's very important. Another common mistake is failing to address or ignoring culture and post-deal alignment. Now, as I mentioned earlier, this is something I definitely want to cover at a later time, more in depth, but if you have two companies or two entities that operate completely differently from a culture level to modus operandi, you need to address that up front or it's going to cause severe problems later down the line and is probably going to make the post-merger, post-acquisition, integration, implementation process very difficult and often will lead to its failure. The last common mistake is not hiring experienced advisors. Now, I know you might just be saying, oh, well, Molly's an M&A advisor. Of course she's going to tell you need experienced advisors. Why can't I just do this on my own with my internal team? I've got a CFO, I've got an accountant, I've got an attorney, what have you. Here's the truth, the sad, hard truth about it. Those individuals, yes, they are experts, and I don't want to devalue them at all, but they are experts on the day-to-day and on executing strategic decisions for what happens inside your business. This is not just happening inside your business. This is something that you need experts in the matter in order to maximize the value that you're going to get out of the deal. It's just a reality. And then, of course, these experts will work with your internal teams, but being an expert in your company does not qualify someone as an expert in M&A. So let's just further supplant that point. Why do you need an M&A advisor or CFO advisor in the deal? That's because an M&A deal is not just legal. It's financial and it's strategic. And here are the ways that an M&A advisor can help. They will conduct pre-deal assessments, handle due diligence requests, build and interpret those financial models, structure the deal for tax efficiency, serve as your financial translator in negotiations, and plan your post-deal strategy, whether that be retirement, reinvestment, or integration. So as we can see, M&A can be one of the most rewarding and risky events in your business journey. Whether you're looking to grow through acquisition or preparing for your exit, having the right guidance makes all the difference. If you're thinking about buying or selling your business in the next 12 to 24 months, let's talk. Visit greenwaldfinancialgroup.com to schedule a free consultation or drop your questions in the comments. I would love to answer them in future videos. Don't forget to like, subscribe, and hit the bell for more strategic content from the Corporate Fixer from Greenwald Financial Group. Thank you.